Hey everybody, thanks for joining in. My name is Yasin Nizami, and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA market, as well as some global macroeconomic factors that is affecting the market, giving some investing strategy so that my audience can navigate through these tough times, which is coming in our way in the future. So, in this video, we're going to cover some events happened in the last 2 weeks, and we're going to start with the US CPI print that came out last week. So if you look at the screen share, so you can see that a CNBC reported a 0.4% rose in October, less than expected. So the overall year-over-year inflation came out 7.7%, which is lower than the expectation. And mainly, majority of the reduction came in the used car sales and the energy cost. And you know that the used car sales demand has suppressed significantly. It is not in the high demand as we had earlier this year because people were coming out of lockdown. They wanted to mobilize themselves. There were not many, new cars available in the inventory, so that's why people were buying used cars, which was driving their prices going forward. But the demand is not there anymore, right? And if you remember, BLS changed their weightage in the CPI bucket, and they increased the weightage in the used car sales. Knew that this will come down, which will of course bring the overall CPI down, and they will do a victory lap. And that's what exactly happened. And we know the reason why oil prices are down right now because the U.S. dumped their SPR reserves in the market to lower the international oil prices. It was an election move, we know that. Um, and now the elections are gone, we will see the oil price will start to go up again because OPEC Plus is going to cut down their production by end of this month. So that's coming our way. So anyway, the inflation doesn't go in a straight direction. It goes up and down. However, when the CPI report came out, the market rallied. Nasdaq, S&P, Dow Jones, bond yields came down, which kind of saying that the market is expecting a slowdown in the rate hike process from Federal Reserve, and maybe Federal Reserve will do a 50 basis points or maybe 225 basis points and then take a pause. That's what the market is expecting. But we'll see. We'll see. Um, but again, this will have an impact on other international countries, including Canada. We know that the Bank of Canada raised 50 basis points in the last round. It was against the expectation. The market was expecting 75 basis points, to be honest. So Tiff Macklin kind of gave a hint that he's also thinking about slowing down the rate hike process. But at the same time, he's saying that uh, we uh, we don't have the recession problem in Canada yet. And again, he's saying the same playbook, right? You know what we saw Jerome Powell is basically quoting. It's the unemployment story. They're saying the job market is too strong. We don't have unemployment rate, and that means people are getting jobs. They're earning money, which is going to contribute into the spending power. But I don't see this as accurate because the job numbers are such a lagging indicator because when these big tech companies are announcing layoffs, like Twitter, 75% people are laid off. Meta announced 11,000 people laid off. Apple slashed their production. Similarly, Amazon is also uh, freezing their corporate jobs. So these big techs, they are cutting jobs. This will have impact in the market. And when they announce the job cut, it doesn't really start affecting the economy straight away. You have, severance packages, you have some notice periods to go, and then people will have some cushions available to meet their ends meet. Then we will see, 4 months, 6 months down the road, the impact in the consumption power. So we don't see any impact of these job losses anytime soon. So this is such a lagging indicator. Yet our central bankers are relying on that in order to tweak their monetary policy. So again, this will likely to overshoot, and we will see some real economic pains going forward. Um, the other thing I want to share with you is we saw one of those leading, private investment corporation, Ramsen Investment. They basically provide private lending to the residential and commercial mortgages. And they're saying that they're freezing their payments back to the investor because they're not seeing monthly payments being paid by their borrowers. So that is showing some insolvencies or borrowers being default at their financial commitment. So that doesn't really sound a positive story at all. And the another private lending company, Home Capital, they are saying that they're seeing a significant reduction in new mortgage originations. So if you look at here, they're saying that 43% their net income is reduced just because there's a drop in the originations um, um, from their lending process. So that really tells you, how slow is the market right now. Um, and again, Tiff Macklin saying, we don't see recession. The job losses has to go up before we see any real impact in the economy. So until then, he will continue to tight um, the monetary policy. And if you look at the CREA stats, we can see the monthly sales is almost approaching the same levels we saw back in 2012, and it's not close, it's not far away from 2010 and 2009 levels, where we had the repercussions after the GFC global financial crisis. So things are really, really slow in the market. Not many transactions, not many inventory either. And the buyers and the seller, they are all sitting at the fence. Buyers thinking, hey, the market is going to further go down, so I should wait. The seller is saying, hey, I'm not getting my money. I'm not going to sell. I'll maybe try next year, this summer, in the spring, or maybe I put a tenant into it and continue generating cash flow. So the people who have purchased the property 5 years ago, they're still generating cash flow, but the people who have purchased property in the last 2 years, they might be in some economic pains right now. So that's really what's happening in the market, guys. So um, my take so far is the market will continue to behave like this in the next at least quarter or two, purely because we don't have demand, but we don't have inventory as well. So the pricing is kind of like at the equilibrium stage. But when we go into the spring market next year, then of course it is expected that the inventory level will rise, and then we will see um, the price pressure will also um, uh, happen as a result of the inventory and the demand level. The other thing I want to share with you is the one of the leading indicators is the construction permits. So what we saw that, let me just share my screen again. Just a second, guys. Where's my screen share? There you go. So we saw there was a significant reduction in the building permits in the month of September, 17.5% drop compared to last month. So this is one of the major leading indicator when your pre-construction industry is reducing their forecast, right? When you see the amount of new permits are being issued much less than your previous month, that means there's not a lot of momentum in the pre-construction industry. So if you are the builder, you see the demand is being suppressed, right? And you see the construction cost is going through the roof, and you see the labor shortage is there, and you're not seeing the interest rate, which is the cost of money, is also getting so expensive. It's not viable for you to, start new construction projects. So we're seeing already the existing pre-construction projects which were started in 2020, 2021, they're delayed or canceled at, from the get-go, just because they don't have enough demand. They were not able to sell those units. In a construction industry, you only get the construction loan when you've sold almost 60 to 65% units. So in a condo market, when a new project starts, the builder doesn't get the mortgage until he showed that he is able to sell, 60 to 65 units already before the bank will cut a check and give them a construction loan. And we're seeing a lot of new projects are canceled just because of that. that they were not able to sell those units, and as a result of that, they were not able to get the funding from the lender to start the project. So that's really happening in the market, guys. Still very slow. It's going to slow down further. The rate hikes will continue happening. Maybe not much as we saw in the last 6 months. But again, the cost of borrowing is so expensive right now. So the affordability is just not there. But the good thing is there's not much inventory either. So that is keeping the price kind of stable right now. But I don't know whether this will continue to hold that price level going forward or not. It will depend upon the overall inventory levels and the demand from the market. What I'm seeing right now, there are not many investors. They are not investors at all. The people who are buying right now are the genuine buyers who would like to live in those properties, right? First time buyers or people who are upgrading or downgrading their existing homes. Those are the people who are still buying, but they're not many, to be honest, because the investor class is kind of wiped out right now from this time. So this is what's happening. Let me know what you think, because the real estate market is very much local. Things in your market might be different than what I'm seeing. So let me know in the comment section what you're seeing, and if you have any question, comments, put them down below, and I'll see you in my next week video. Take care.